Hello, friends. The new year 2022 has witnessed a somewhat volatile start where the equity markets are concerned. Now, despite the volatility that we have seen during the month, the Nifty index ended largely flat in the month of Jan 2022. Now, as you all know, that the equity markets have had a great run in the last 18-month period. Now, however, we are starting to see some moderation from the peak that was touched in October of 2021. Indian markets are, however, not alone. Globally, too, markets which had touched a peak during the last year have seen correction. So, for instance, markets such as the Nasdaq, Japan, Brazil, and other emerging markets have actually dropped more than 10 to 15% from their 52-week highs. And in fact, Indian markets continue to be among the best performing markets globally, outperforming the emerging market pack over the last 3 months. Now, the volatility that we have seen in the Indian markets has been largely on the back of global factors, ranging from the global risk off, which was on the back of the Fed's hawkish stance. Now, as you know, the US Federal Reserve meeting was held on 26th of January. And this raised the risk off sentiment because the Fed chair, Jerome Powell, hinted that high inflation may be prolonged. The chairman also indicated that the Fed would proceed with balance sheet reduction, and this would potentially reverse the ultra loose monetary policy that we have seen since the pandemic began. The US 10-year bond yield has also spiked post the Federal Reserve meeting to about 1.8%. And in India, too, we have seen the 10-year GSEC yield rise. However, the rise in bond yields has been seen across the world, and India is not in isolation. There have been also certain geopolitical issues which have resulted in the crude oil prices rising to about $90 a barrel. And this has created some further macroeconomic uncertainty in the country. Now, with higher crude oil prices, one does expect to see some impact on India's macro parameters. But the external balance sheet of the country this time around is much stronger than was the case during the taper tantrum of 2013. Further, RBI's forex reserves, which are at over $630 billion today, provides the ammunition that the central bank needs in order to curb the volatility in the currency markets. Now, the key event that took place recently was the union budget, which was presented on Feb 1st. And this was presented in the backdrop of the country navigating the third wave of the COVID pandemic. Now, this was clearly a pro-growth budget, with the government's key macro focus being infrastructure growth and boosting capex spend in a bid to sustain the investment growth momentum that we have seen over the last few years. The government continues to focus on long-term growth drivers like infrastructure, encouraging entrepreneurs and supporting startups. The highlight of this budget, as I said, is that it sets the foundation for structural growth over the next few years vis-a-vis what we have seen in the last few years, and this is through investment spend. The budget provides an impetus that is required through various policies, and this is over a period of 25 years in order to steer the economy structurally and to enable job creation. The infrastructure growth focus is clearly visible and is outlined under the umbrella of the PM Gati Shakti scheme. In fact, capital expenditure growth for FY23 is budgeted at 24.5% over the revised estimates for FY22. Now, the budget outlined a fiscal deficit of 6.9% of GDP for FY22 and 6.4% for FY23. The budget documents, however, reiterate the commitment towards a broad path of fiscal consolidation over the period FY25-26. The other thing to note is that while the figures for the gross and the net borrowings that were announced in the budget were slightly higher than what was expected by the market, one must note that the budget really estimates nominal GDP growth at only 11.1% in FY23 and net tax revenue growth of 9.6%. These numbers could actually have upsides given the pace of economic recovery that we have seen so far. And also at the same time, the disinvestment target for FY23 looks quite reasonable. Overall, we believe that the budget is positive for the equity markets. It hits the bullseye in terms of its focus on structural growth with higher spend on capex and no major changes on the taxation front. It clearly sets the stage for long-term sustained and structural economic growth recovery, with investments and infrastructure being the key growth drivers. Now, you also know that we are in the midst of the Q3 FY22 earnings season. Now, so far, the earnings outcomes that have been declared have been largely in line with estimates. Now, while the top line growth or the revenue growth has been strong across sectors, reflecting improving demand as well as better pricing power, we have seen some margin impact, primarily on account of higher commodity prices. Now, the expectations for Nifty earnings growth for FY22 and FY23 remain robust and strong. However, the pace of earnings upgrades are clearly reducing. In terms of some of the high frequency economic indicators that we track, because of the onset of this Omicron-led third wave, states have imposed some restrictions on activity. These restrictions have been milder than what was seen in the previous waves. However, there has been some slowdown in sequential momentum in January because of these restrictions. However, we believe that as the third wave starts to come down, this trend will likely reverse. And in fact, now most states are lifting the restrictions that have been imposed. The data on GST collections continues to show improved buoyancy and economic recovery. And in fact, the data for January 2022 that was announced shows that the GST collection stood at over 1,40,000 crores, which has been the highest ever collection in a month. In a nutshell, India appears to be in a structural uptrend with a likely new profit cycle and improvement in capex trends and a very supportive policy environment. However, in the near term, we do expect that there could be some challenges which leads to volatility in the very short term. Now, while earnings growth for Indian companies remains strong, the pace of earnings upgrades have slowed down, and the market is now trading at the upper end of the valuation band, both in absolute as well as relative terms. This therefore continues to be a stock picker's market, and bottom-up portfolio building is our strategy. However, over the medium to long term, equity remains one of the best plays in terms of asset classes. So therefore, what we are really saying is at this point in time, we continue to maintain our neutral allocation to equities in the overall asset allocation basket, with a slight preference for large caps over mid caps. Now, some of the key themes that we are positive on currently include, number one, the revival of domestic capex and infrastructure growth. Two, improvement in household capex and the revival of real estate as a sector in terms of growth. Three is financialization of savings and the continued shift in market share in case of both loans and deposits towards large private sector banks. Four is the export opportunity and the China Plus One strategy and supply chain shifts away from China. And finally, fifth, we believe that digital adoption is here to stay, and the digital transformation journey of many companies is a long-term structural trend. From here on, a few key events to watch out for include the upcoming state elections, trends in vaccination, as well as monetary policy outcomes for both India and globally. Some of the key risks that we also need to watch out for include the movement of bond yields both in US as well as in India, the pace of interest rate hikes done by the Federal Reserve, any geopolitical risks and the impact that it could have on crude oil prices, and finally, and importantly, the earnings growth trajectory for corporate India. In conclusion, we would advise everyone to continue with a disciplined approach to investing, keeping in mind one's financial goals, risk appetite, and asset allocation strategy. And remember, SIPs or systematic investment plans continue to be one of the best tools for long-term wealth creation. Thank you very much. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.